Hi and welcome. This is CCP Zipporah Jeroge once again. And today we are on our module, should be our module number 4. And in our module number 4, we are basically going to talk about delinquency control management. And when I talk about delinquency control management, this is a term that is very common to lenders, especially lenders in the financial sector, ranging from the SACCOs, from SACCOs, that is microfinances or banking sector. The word delinquency is a common term that you will find that is frequently used in those institutions. But it is also a term that can also be applied in other lending, what we call other lenders, like the trade credit and all that. But mainly it is more into the business of lending money. So I want you to sit back, relax, as we walk together through this module, and I'm sure you're going to learn a lot as far as the delinquency control management is concerned. We will be looking at what we call the basic concepts and principles, in delinquency control. That is, we would want to explain further, to define further, to elaborate further what delinquency is all about in lending and even outside lending, in real life situations. We are going to look at cost implication and measuring delinquency. We are also going to talk about ways that we can be able to analyze and understand the causes of delinquency. We are also going to talk about steps that we can undertake when in terms of detecting the delinquency and the action that we can undertake to minimize the aftermath or the effects of delinquency in our institutions. Then we also look at actions to take in delinquency crisis. Probably we find ourselves in a crisis. What step should I take, or what step should the institution undertake in such a scenario? So those are the things that we are going to look at in this session. So feel free, even after the video, you can always ask more regarding the same so that you can be able to understand. So let us go to our point number 1, the basic concepts or the understanding of what we are calling delinquency management. And when we just look at the term delinquency, this is a condition that arises when an activity or situation does not occur at its scheduled or expected date. So we look at it more when it comes to lending. So something that you're expecting to happen today and that does not happen, then you can refer to that outcome as delinquent. That is, it doesn't happen when you expected, but happens at a future date. So that means there was a pre-agreed schedule which has not been followed or which has not been performed as it was expected. Delinquency also implies that an obligation has not been discharged per the scheduled date or time. Now, when you come to lending, therefore, we can apply what we are learning from the 3 points on our first presentation. Then we can see that there is a condition. So this condition which arises, for example, when you have lent money and you are expecting a repayment on a given date and the repayment does not happen, then that tells us that outcome, we can refer to it as delinquent. That is why in lending we are saying that it is a situation in which the borrower misses its due date for a single scheduled payment for a form of financing. So if you are anticipating or expecting a repayment today and the payment does not come through, then we can comfortably say that that account has become delinquent because the payment that you anticipated or expected has not come as you anticipated. So when this has happened, of course, a lender should take some steps or is responsible for taking certain actions in order to regularize or to ensure that the customers pay on time or the customer perform their part of obligation as they are required to as per the scheduled timing. So when we are talking about now delinquency, there are things we need to do even before delinquency has happened. So we are saying we must have a set of policies and procedures in place to guide us as far as accounts are concerned or payment by a customer is concerned. Then we as an institution must also promote a repayment culture. We should not tolerate or encourage customers to miss on repayment. Remember, we have said delinquency occurs when you are anticipating a payment on a particular date or a particular day and the payment does not come forth. So delinquency comes as a result of that. So therefore we are saying that we need to promote a repayment culture to our customer. Let us not show them that we are okay even if they delay in making repayment. Then the other thing that we need to do is also to instill discipline to both staff and borrowers. So even as a staff, you also need to take an action has to be taken against to encourage, to ensure that your customers are also paying as per scheduled timing. Then of course, then the other part the company needs to take is to take plans or to make plans for events that may be beyond their control. For example, some events are beyond our control. Maybe a payment was due yesterday, and then yesterday maybe was a holiday, and the customer could not. Those are maybe things that are beyond our control. Or something happened. Maybe there was a pandemic or outbreak, or maybe there was a riot, for example, and the payment would not come through. So we also need to plan for such events. What do we do? So if we know that those events can take place or can happen, then we will take precaution in good time. We can have a way to make sure that our customers are able to pay at the comfort of their home, even without making any movements where it calls that movement cannot be possible at that time. Also, why do we get into delinquency situation or a condition? This one we normally say it is caused by two factors. One, the ability to make a payment or lack of money in terms of making the payment, and this could be on the side of the customer. And the other one is willingness. The money is available, but the customer just fails to make a payment. So when we find ourselves in a delinquent situation, it's always good to find out, is the delay in making the scheduled payment as a result of the ability? Is the customer having financial challenges? Or is it because the customer has no willingness? That is, they just not make the payment when they were anticipated to make the payment. So those are usually the two major causes. One, the ability, lack of money. The second one is the willingness not being there. And this one boils down to the character of the borrower. So if the borrower is used to not making payment or not honoring the due dates, then we can find that the willingness aspect is causing the delinquency to take place. So the other question that I want us to ask ourselves, and we always ask ourselves as lenders, when does delinquency start? When do you think delinquency began? Is it on the due date when the customer did not pay us, or there is a time that is it something that was prior to the repayment being missed out by a customer? And when we are thinking of when did it start? Let me go back to that. When does delinquency start? We actually say that delinquency does not start when the customer fails to make the payment. This is a condition that might have even started from the word go, or at the onset of the relationship, or when we were carrying out our assessment or risk assessment. Probably we didn't do it right. We did not establish whether the customer had the ability to pay or the customer was of good character. And this now boils down to the 5 C's of credit or the 8 C's of credit, maybe that now we talk about them a lot. So delinquency does not start on the date that a payment has not been made, but it might have well started long ago when the customer was onboarding, from the onset of the relationship. Onboarding, that is when we onboarded a bad character or a customer who could not honor the obligation. Then the other part that we were to talk about was what we call the cost implication. and measuring of delinquency. As an institution, when delinquency has occurred or delinquency has taken place, are there cost implication? Remember, we were expecting and we were anticipating that payment will be made of this magnitude will be made today, and then payment does not come. Maybe we have scheduled other disbursement for today or tomorrow because we anticipated the payment, and then now the payment does not come through. Of course, there are a lot of implications. There is the opportunity cost that we are going to incur. There is the cost of financing we are likely maybe to incur because we might look for alternatives to fill in the gap that has been created by the lack of payment. We are maybe likely to make some steps like visiting the client, incurring cost traveling to make sure that the customer honors the payment. So there are cost implications as far as delinquency is concerned. And one of these costs, one of the costs that maybe you can talk about mainly is what we call slow rotation of the portfolio. So the portfolio will not rotate as you anticipated. Rotating the portfolio, here we are saying that if we had people who are waiting to be funded today with the funds that we were to receive today from our customers, it means that those proposals cannot be funded because there was a delay in the payment from the customers. So delinquency slows rotation of the portfolio, and it is through the rotation of the portfolio or through the repayments that we are able to build, we are able to make more money, we are able to give more loans, to give more credit facilities that will encourage customers to maybe to keep on borrowing with us. The other one is delayed earnings. Remember, when we do lending, we lend to earn an interest. And always, maybe for example, if it's a bank, the money belongs to depositors or the money belongs to shareholders or the financials of your institution. So when we get into a delayed maybe or delinquent condition, then there is what we call delayed earnings. Our interest will not come on time. So sometimes we may even end up losing the interest. So the other one is the increased collection costs. We might start visiting these customers. We might start making phone calls. Of course, we do that. We might incur legal costs. We are also likely maybe to even incur a debt collection cost. So all those we keep on incurring at that point. So the other one is increased provisioning for bad debts. That's another cost we incur when customers don't pay us on time. Increased provisioning for bad debts. And one thing we need to know that provisioning for bad debts is a cost. So these costs, it's up to on our profits. So we'll not be able to make profits because we have set aside some earnings in anticipation, or maybe because we have already identified bad debts as far as repayment of the loan is concerned. There is the other one, loss of credibility as an institution. When you are into so much delinquency position or delinquent position, we also lose credibility. Who wants to invest? Who wants to put their deposits in an organization that cannot assure them that when they need the money can be withdrawn? The other one we can talk about is increased repayment problems. So when an account has just become delinquent in one repayment, by the time now it's another month, actually the burden becomes even bigger and bigger. So we end up incurring more costs and even getting into problems of being repaid for those loans. Then the other one, it threatens long-term institutional viability. So there are institutions that have had to close down because the customers who are given credit facility never paid on time. They did not return the funds as they were anticipated. So we end up, our position as an institution is threatened in a way that it is not also able to meet its obligation when it is false due. The other part we also see is that provision for defaults have direct effect on income and assets. So when the customers become delinquent, or when the loans become delinquent, we are also getting into problem because our assets will not yield what we anticipated or expected them to yield. So that also affects our institution. So on cost, I think that is very clear that there will be slow, and there are many other things that are related to delinquency. So we incur cost. Yes, we can affirm that we are going to incur cost as far as delinquency is concerned. The other way now, how do I measure delinquency? Because we talked about cost and measuring. We measure delinquency in a major way. We measure it in 3 ways. And there are 3 indicators of delinquency that we can use to measure our delinquent position as an institution. And one of them is what we call the collection rates. And these collection rates, how do we do it? We measure what we have collected or collected from customers, or what has been paid by our customers against amounts that have fallen due. So if today we are to look at our delinquency position as an institution, we will compare what was to be paid today and what has actually been paid. Then we get what we call the collection rate. What is our percentage as far as collection is concerned. Then there are number 2 that we use to measure our delinquency position is arrears rates. That is, we want to measure measure overdue amount against total loans amount. What is our arrears, the rate of arrears? And thirdly, we talk about portfolio at risk. What is the portfolio at risk? Also, when we are measuring portfolio at risk, we are actually looking at the outstanding balance of loans not being paid on time against outstanding balance of the total loans. So assuming maybe we have a category of 31 to 60 days, those are delinquent, we are calling they are delinquent. When we want to know what our portfolio risk ratio is all about, we will take that amount of, that is the amounts that are owed at that particular age bracket compared to the total balance. So when we are looking at this, we are able now to tell our position as far as portfolio PAR is concerned, arrears rate is concerned, and collection rate is concerned. So collection rates, we talk about amounts collected over amount that have fallen due. So the numerator is the actual cash collected of the principal, and the denominator is the principal amount that was due to be paid. So how much were we expecting and how much have been paid? We make a comparison of that. The other one we have talked about is the arrears rates. This is late payments over the total loans. So the rate focuses on the amount of late payments, dividing this number by some measure of total loan activity. So to see the outstanding portfolio. And the third one we've talked about is what we talked about, portfolio at risk. So this is the outstanding balance of loans with overdue payments over total outstanding balance. So this both numerator and denominator, we say that it is the unpaid balance of loans with late payments. All we assume now everything we are at risk. And then now, well, the denominator is the unpaid balance on all the loans. So all the loans with unpaid balances divided by total outstanding balances. Then, of course, the numerator, we say that captures the amount placed at increased risk by the delinquency. Because we see that the more the delinquency, then the higher the chances that the entire loan is gonna be defaulted. So that is what we try to establish when we are looking at portfolio at risk. I hope up to that point you can be able to explain what delinquency is. You can be able to highlight costs related to delinquency. You can also be able to talk about the measures that you use as far as delinquency is concerned. So that first session, what you need to know is what is delinquent. So when you are told the accounts are delinquent or there is delinquency issue, you should be able to know what the term means. You should also be able to know the cost implication of delinquency. We should also be in a position to know how ways of measuring the delinquency position of your institution. So welcome to our second part of this presentation, and we want to talk about cause of delinquency. Of course, when you see cause, there are a number of them. The cause is, we cannot look at the cause of delinquency as one. it could be a number. There could be a number of causes, underlying reasons why the payments are not forthcoming. So causes of delinquency or cause of delinquency, we look at a number of them, and how we normally look at them from the image that we are presenting there is the causes of delinquency could start from maybe natural disaster or natural calamities, the issue of flooding, failed crop when there is drought. It could be maybe as a reason of maybe the earthquake, all those manner of natural disasters that come our way or come the way of the business could cause delinquency. Then the other one that could cause delinquency, it is the government policies. Sometimes government changes policies that affect the repayment ability of a borrower. For example, when the government probably just comes up with a policy that no more exporting or no more importing of a certain product, or a certain market has been banned, maybe it's no longer, you're no longer allowed to trade with that particular country, then you find yourself that as a borrower, you'll be unable to pay the loan, or as you as a lender, you will not be paid because of the policies. And a good example, for example, in Kenyan markets, we saw a change in policies by the government that banned use of plastic bags. So imagine a manufacturer who had polythene bags in stock. They had maybe they had stock, they had just ordered, and maybe they were anticipating or they were expecting a delivery. Then the government policy changes, and within 3 months, 6 months, the law is enforced. Then you are likely, this customer who was into this business, who was already manufacturing and doing all manner of business as far as plastics are concerned, they might end up having a problem. Then the other one is individual crisis. We see sometimes people have they have crisis in terms of their financial position or their ability to pay the loan. They would maybe be unable to honor their obligation. Maybe mismanagement, probably what we call misappropriation of funds, probably maybe they didn't have the knowledge, the capacity to do the business they borrowed for, and therefore the business failed, so we get ourselves into delinquency. Diversion of funds, this is common with the individuals, they divert funds, or probably loss of job, which is beyond the control of the borrower. So those are some of the factors that may cause delinquency in an institutional portfolio. Then the other one is the economic conditions. Like now, maybe at a time when the economies of the world are having a challenge, maybe there is a shortage of dollar and the loan was in dollars, the company or the client may be unable to perform their obligation due to that shortcoming in what we are calling the forex challenges. It could be there is a high inflation. It could be the economy is not favoring a certain kind of business, and there is a failure of the business, and the customer is unable to honor or to pay their loan. So those are some of the things that may cause, but we will look at a number of them as we progress that causes delinquency. And how I have done it, I have classified them into 3. These one are what we call organizational or internal factors. They may cause a delay in getting paid. We're also talking about borrowers factors, and then finally we'll talk about external driven causes, which I have already mentioned in the earlier discussion we've just had. So causes of loan delinquency within the organization are, of course, a number of them, and maybe you can relate with some of them in your institution. And this one is what we call about, one of them would be laxity in screening or recruiting customers. We actually talked about the delinquency sometimes takes place even before lending has been done. We can use the analogy of garbage in, garbage out. So when you recruited a customer, probably this customer has a bad habit, he's actually even or she's actually or it is actually listed with the Credit Reference Bureau by other borrowers, but we were lax in our due diligence. We did not carry out a proper recruitment, or it is where we are sourcing for our customers, they have the challenge in terms of they are not good payers, they are known to be defaulters. So laxity in screening or recruiting customers. So if you recruit quality customers, quality loans, you shall be able to disburse. The other one is poor or inefficient processing of loan application by staff. So some loans, we don't take the process, we don't take the procedures or the processes that have been laid down. Maybe probably it's because you know the borrower or you have a relationship with that borrower, and that application is not taken through the normal process or the laid down procedures or processes within the organization. The other reason or cause of delinquency is poor monitoring, recording, and having maybe in relation to recording and reporting systems. Probably do not have good systems in place. We are not following up these accounts in a right way, and all that. We are not, after we disburse, no monitoring. We are not checking the customer's performance, their account performance, and maybe once we lend to them, they stop banking with us. They stop saving with us, and that is a red flag. That is an indicator that there's something is wrong with the customer that we are lending to. The other one would be weak collection system and procedures. We are not collecting. We are not following up. There is even maybe no one following up, or even the people who are following up, they have got no idea of how to do the follow-up in the right way. The other one is the irrelevant, disseminated and unwritten lending policies. We have, we do not have lending policies, lack of collection policies in place, our lending guidelines, our procedures are not even written, they are not known to even staff. I interact with a number of clients, and sometimes you ask some staff, have you met or have you seen or have you interacted with your credit policy or procedure? And the answer I get, I have never seen it. I know it is there, I have never seen it. So that also causes or leads to what we are calling delinquency. The other thing is poor staff services. We failure maybe to offer good services to our customers. We annoy them, we anger them. So in retaliation, they don't honor their obligation when they're supposed to honor it. Poor leadership, bad management. A management that is also doing shoddy dealings. It is lending under the table, and things are not done the right way. We have maybe governance issues within the institution that also causes delinquency. And then the other one is officers' poor attitude towards training. There are people who have no training, no background, and maybe whenever a training is offered, they are not willing already even to get into that training. So this also causes, you are not up to date with the current event as far as lending, collecting is concerned. And then the other one is lack of clear outreach target groups. The quality of customers that we are going to target will also imply that we will have quality or good quality or bad quality loans. So we need to also map. We cannot give everybody. We cannot please everybody. We need to establish a niche for our product as an institution. So the other one is supply versus, we can talk about supply versus supply forces. The market forces that are prevailing. Probably the customers are not taking up loans or because of what is happening, and there are outcomes that make customers not to honor or to pay their obligation as well, leading to delinquency. Then giving maybe what you call recovery process being lenient. Recovery process lenient or leniency. So the process is, okay, we understand, when are you going, you are not stamping your foot. You're not telling this customer that this is when we anticipate the payment, and if not now, this is what is going to happen. The other factors are wrong loans. We can give a wrong loan, a working capital loan, which should be maybe 6 months. You start giving it for a longer period of time, and maybe it has high interest, so they become stressful even to the borrower, and they are unable to service the loans. Or you give a loan for an asset which is not yielding any income, and then we expect to be paying within a short period of time. So wrong loans also lead to non-payment. Causes of loan delinquency by borrower, that is borrower factors. This we had already mentioned. I think one of them is inadequate paying capacity, which we did not establish at the point when we were onboarding the customer. Misappropriation of funds, we have mentioned that. Lack of technical skills in running the business. You give a loan to a startup or to someone who has no idea of what we call maybe a profession. They want to try something and they have never done before, so they fail because they do not have what we call the business acumen in relation to that particular product. The other one is lack of financial skills. Customers lack financial skills. They don't know how to bookkeep. They don't know how to manage their finances. When you ask for audited books of accounting, they are not available. So the business is never audited. So you get into that kind of problems. The other one, of course, of borrowing. Most of them are over-indebted, so they get to a level they are not able to service their facilities or the loans. And then the other one is unwillingness to pay, lack of willingness to honor the obligation. So that also can lead to delinquency. Then external factors that lead to delinquency, we mentioned a number of them, is death or illness of borrower, local and national world economy, currency devaluation. It could be pandemics, like in the past we have seen the pandemic, corona, that made so many businesses go under, close, lives were lost, and therefore loans became bad. Of course, when the death happens, if the loan are insured, then there is no problem. So the other one is government taxation, import and export policies, changes within a nation that can also cause the customer to maybe to lack the ability to repay or to honor their loans. I think up to that point, in our second part on that, we can be able to elaborate, we can be able to explain, we can be able to identify causes of delinquency. So we cannot say that delinquency is caused by only one. It could be actually caused by all the three. The failure of the organization, maybe to have policies in place. It could be as a result of the customer activity or not doing what they're supposed to do. It could be as a result of government measures or policies, taxation, or calamities. That is what we are calling external factors that may lead or may cause delinquency. Remember, we have said delinquency is an outcome that has happened because when you expected a payment, it was not made by your customers. Allow us to go to our next part, our next session. Within that, and this one, we are talking about delinquency controls. What controls can we put in place to manage or to control delinquencies? And I think the very first thing, why we want to control delinquency, that is the objective of controlling delinquency in an institution. I think this is basically to reduce losses. So whatever measures you can do to reduce causes of delinquency, then this is what we are calling as controls. So objective of delinquency controls is to reduce losses due to delinquency. A reduction of losses due to bankruptcy, insolvency of the borrower. So we want to take measures even before we have gotten into delinquency. When you are putting controls, these are preventive measures. We are doing it to protect delinquency taking place. So we want to minimize. We cannot do away with bad debts. Whenever we are lending, you can't do away with bad debts, but you can put some control measures to prevent or protect your institution from getting into bad debts. The other one is protection of the lending institution from undue exposure to liability. So we need to control, because Once delinquency has gotten to another level, even our institution cannot be able to meet its liability. Imagine a bank that that has loans that have become delinquent, and they are unable to repay depositors cannot get their deposits on demand. Then that means that institution will be under pressure, and they will also be exposed to liability. And maybe probably, unless the CBK or the central bank or the federal government, federal bank intervenes, then you can get yourself into challenges. So we are saying objectives of controlling delinquency is to protect your institution from undue exposure to liability. Liability is what we owe others. So when you're not being paid, or when you're not collecting from your borrowers, then you cannot also pay your suppliers, or you cannot pay the people you owe money, like the depositors. So that is important for us to know. So those are the key objectives: to minimize losses, maybe to minimize the effects of what we are calling bankruptcy or insolvency of our customers. What are the perceived benefits? What do customers perceive as benefits in terms of not repaying you on time? Customers want to pay late. They have some perceived benefits, and one of the key things they perceive for not paying you on time is they want to lower expenses if interest is not paid. So interest is an expense in the books of a borrower. So if they delay the payment, then they will be able to, they will have some money within the institution. So the other one is to maintain capital from loan in business. They want to, because when they repay a loan, it means they are moving money from the business to pay the loan, and that is money they are moving. So they want to hold a little bit on the funds that they're supposed to pay the lender, so that they can be able maybe to turn around and sell or do more in their business. They also perceive that they don't have to make many trips to make payments. We still have customers who insist, I will come and make a payment. So they feel when they delay, they are making some savings. The others talk about they will have low transaction costs. They believe when they repay, there are costs involved. They will be charged some costs. The other one, eventual benefit of not paying at all. They anticipate. They look forward. They know if you delay a bit, you're not asking for the money, you might forget, and it will be for their own benefit. Then there are the other customers who perceive that there are benefits of paying you on time, and this one, they probably want to get a bigger loan. They want probably a favorable terms on them, so they come and pay. But the bigger category will be on the other side, their perceived benefits. Then the other one, on time payment to borrowers, they perceive that development of positive credit history. Some are enlightened. They know when they pay on time without delay, it adds them what we call their credit scores, or their credit rating is improved with the bureau. And then the other one, they also want to have a positive reputation among peers. They want to access other services within your institution. Probably you have different types of products they would want to approve, they would want to enjoy. So they will see that if I pay, I am going to benefit. The other one is they consider that they're going to get a lower interest rate on subsequent loans. So if I pay on time, I come next time for a new loan, I'm likely to get a lower rate. The other one is they look at interest rebates. They are looking forward that maybe you might decide, because you've paid well on time, we are going to give you a rebate on your interest. But there are perceived costs of late payments, or no payment by borrowers. What do we suffer, we as an institution? Of course, this one, there are costs which we surcharge the customer, which are usually late fees for late payment, delayed future loans, possible legal action against the customers, possible loss of collateral, frequent visits by loan officers, negative reputation. So customers also know that there are costs that are related to delayed payment, or that when they don't pay on time, they are going to incur this cost. And this is very important. When you are doing controls, when you are putting controls to delinquency, it is good to understand where your customers are coming from. You need to understand the position of your customer. Are they them that perceive that it is beneficial not to pay on time, or is it they the ones who perceive that repaying on time is of benefit, and do they understand the cost implication on them when they don't pay you on time? So the controls that we need to take and to put in place so that we can take charge of our lending business is, one, we must implement effective methodology or appropriate product design. We say sometimes the product we offer, offering a wrong product leads to delinquency. So implement effective methodology or appropriate design your products so that those products are in line with the needs of the customers. Create an image and a philosophy that does not make late payments acceptable. This is where we are saying you need to cultivate your borrowers' habits. Discipline is learned over time. Make sure that they know that you don't tolerate or you don't entertain late payments. So the other one is make products that suit client needs. Make sure that even as you're developing, you make sure that those products you have developed are meeting your customers' needs. Design loan sizes and terms that don't make repayment difficult. We give some loans that are, that are automatically defaulted even before a customer has even taken a loan. Make sure the terms are well explained, the terms are well designed, and they are well known to our customers. Then the other one is you can employ incentive system. This is where you are encouraging you're having maybe some form of rewards, or they could be non-financial incentives to encourage customers to make repayment. For example, you can have some incentives whereby you are calling customers even for training. We said one of the key contributor of non-payment is lack of financial knowledge. You can make some trainings. Customers will pay you on time. You invite them to these trainings. They are trained and they become better in running their business. The other one, you need to ensure that the borrower perspective or repayment benefit outweigh the benefit of a late payment. Make sure we have seen what customers perceive. When they pay us late, they perceive they will benefit. So make sure that the benefits of paying, they outweigh the benefits of late payment. The other one, you develop systems that provide information on time to conduct effective and timely follow-up of loans. So a system that will remind, a system that will show you customers that are anticipated or expected to make payments tomorrow. Make sure you have a good system in place. Then the other one, we talk about timely and useful analysis of portfolio quality. So you need to do a lot of monitoring on your portfolio to make sure that nothing goes unnoticed, to make sure that your customers are paying and they're doing what they're supposed to do in good time. Then effective follow-up, collection, follow-up. If the customer was to pay today, no payment, make sure they have heard from you. Let them know that you have noted that they have not made any payment. But if you wait 5 days, 10 days before you make a payment, my friend, the customer will become accustomed and they'll have a culture of late payment. Then the other one is you must have an established target level of acceptable delinquency. So do not allow customers, to become delinquent, and you're taking no steps. You are doing nothing towards the delinquency. So make sure that you have cultivated the urgency of making payments by your customers. Then the other one is know your borrowers and your borrowers' business. What business are they into? Because it is that business which you have funded that will repay. You need to know when do they normally receive the payment. Even a payment, when you're designing their loans, you need to know that repayment will be possible by the 20th. Don't put repayment on 5th. Well, clearly you know the kind of business your customer is into. So know your customer and your borrower's business. It is your business because you have funded them, they have your money. Then we also say you ought to maintain close contact with your borrowers. Once your customers or once the borrowers are borrowed, do not cut short your relationship. You need even to cultivate it further. Actually, if there is a relationship that should be maintained, in and maintained on a serious note, it is the relationship after disbursement. Before disbursement, you had nothing much to lose, maybe other than the interest that you earn from that loan. But now, after you have disbursed, there is a lot at stake. There is the interest, which is at stake, and there is the principal, which is at stake. So we need even to have a better relationship with our clients after we have lent unto them. The other one, you must have accurate management system. Please don't issue loans and you do not have a system that will enable you to monitor, follow up, and be able to follow up through the loan until the final repayment is done. Then the other one, you can ask your customers where you feel you are highly risk, you're highly exposed. You can ask them to provide you with a collateral. You can also ask them maybe for an insurance cover. The other one is offer small loans to new borrowers. So if I am new in your institution, please don't load with a lot of money to a new borrower. Go grow with the customer. You can start small as you continue monitoring, as you can get to know them better and better before you disburse big loans. Embrace transparency. This is another key area. When you are lending to a customer, please do not hide any information. This is full disclosure is required. Make sure the customer knows, they understand, they have been told all the charges that are there. Because if there is one thing that will lead to delinquency, is when a customer realizes that there is some charges that you did not disclose. So along the way, they will pay and feel, no, this is too much. You never told me about this charge. You never mentioned to me about this. And delinquency may start from that point. So embrace transparency. Sit down with the client. Disclose all the information. Let them make a decision to borrow based on the information you have provided. Then the other one is prevent over-indebtedness. If already you have analyzed the customer's books and you've realized they have overborrowed, they have borrowed Paul, they have borrowed Tom, they have borrowed XY Limited, and you can clearly see these guys are, they are everywhere and they are indebted. Why add more pain? Because most probably they will get a loan or a facility from you, go pay the older accounts, and then now you are the only one who will be left with a challenge. So that's why we are saying prevent over-indebtedness by all means. Make sure you do that. Then the other one is fair and respectful treatment of clients. Some clients default, accounts become delinquent because of how we treated the customers. So if we want to maintain good relationships with our customers, then we ought to maintain fair and respectful relationships with our customer. So when we are talking about debt, is a relational issue. Debt requires to have good relationship with the borrowers. Remember, our money is at stake. So a relationship will go a long way in making sure that we get paid on time. Other controls that we can put in place, we need to modify our credit strategy for long term to manage exposure and ensure that where we are realizing their what we call shortcomings, we modify and we come up with a better strategy. We eliminate underperforming products. We know those products that are making us exposed highly to loss. We make sure that we do away with them. Then we also do what we call loan monitoring after disbursement. Let's not just sit back and wait for things to happen. I have an analogy that says money has no legs, so you have to go for it. So you have to ask for you to receive. So actually, the verse that talks about seek and you shall find, knock and the door shall be open, ask and you shall receive, applies accurately in the area of debt collection. And I think if you are able to adopt those measures, then we can comfortably say that then you will have put some controls that will help you in managing delinquency in your institution. So you can think of more, you can even review your credit policies, look at procedures maybe that are making it possible for bad payers to enter into our institution. All those things we need to have a look at them in a proper way. Then the next one that we can talk about is what steps do we take to deal with delinquency? So we have controls. Controls, we said, these are before things have gone bad. And now already we are in a delinquency situation. What is this that we need to do? Maybe for the next few minutes, we can talk about steps to deal with delinquency. That one, ensure your service is valued by your clients. Make sure that the service you're offering is valued. Customers want to remain with you. You should screen your customer carefully using the 7 C's. The 7 C's of credit, we've talked many about them in the other modules. And this one, we are talking about character. We are talking about capacity, collateral, condition. We are talking about the other ones we talk about are cash, controls in the business. Make sure all of them, they are well taken care of when you are doing that. Stratify the market. Identify your niche. By the way, you cannot serve everybody. You must know what is my niche, right? And then the other one, you ensure the clients and staff understand the late payment and unacceptable. Make sure this is drilled into the brain of your staff or credit officers to know that these unpaying customers are not entertained in our institution. Establish effective follow-up procedures. Ensure the consequence of loan default is unappealing to your customers. We also say you need to analyze the origin of deteriorating portfolio. Where did the rain start beating us? What became of it? Which specific industries, which specific subsectors are having a challenge? What has caused the problem that we have? Then you reaching out to customers to discuss and deliberate on repayment. Check if the customer has a temporary liquidity issue. If it's temporary, you may decide to reschedule the loans or so that you can support these customers. Then the other one is also, we say, make sure that you have a digital solution to support repayment, timely repayment. Then you motivate the loan officers to ensure focus on quality portfolio. So those are things that we can adopt so that we can be able to handle delinquency in a good way. Then the other one is check if loan portfolio deterioration does not breach investment covenants. So you have to be on top of the game to make sure that the loan portfolio which you're handling is within the investment covenants that you have even with your financials. Adapt a strategy to safeguard business continuity by focusing less on risky activities, decrease number of credit and loan sizes. So you can look which loans, which category, which sector is giving us a big problem. So you can be able to minimize on that area. Then when we have, finally, when we have a delinquency crisis, what is this that we need to do? We know how to control, we know how to measure. Therefore, we are asking, now I am in a crisis. And I know as we are having this conversation, we have institutions that are already in delinquency crisis. And you're asking, now, what should we do? Let me say, all is not lost. A lot can be done. And you can take some action. It is never too late. Take action and now start putting control measures even as you are taking care of these old accounts. Review your policies. Of course, number one, you improve on quality of your appraisal. You evaluate your loan officers' compliance culture to check who is this that is causing this problem. You need to retrain your credit officers. You need to design incentive and penalty systems. You need to move stubborn loans to a specialized collection department. You can have an internal collection department assisting in follow-up of loans. You can refinance some of your customers that are having problems so that you can rehabilitate them to be able to pay. Then you can also make sure that you set guidelines for improving performance and reward achievement. You can just decide and tell customers, if you're going to pay within this period, we are going to waive this interest or these penalties. Then customers can take advantage of it and come and make the repayments. Then you can review performance of your new versus old loans after about 6 months under new policies. So you look at the new loans, the old loans after the policies you have made changes on. Then the other one is you remove loan officers who continue to perform poorly. Sometimes we have to make that decision. of telling people kwaheri or bye in English. In Kiswahili we say kwaheri. Then the other one is appointment of recovery agents or in-house enforcement staff so that they can follow up and even assist in getting payments. You can do the recovery through legal or what we call court processes. You sue those that can be sued. You seize what we call collaterals. You sell them off and you get paid your money. And as we come to a conclusion, as we end, what we need to take home on delinquency, I think we have learned a lot on that. And I think one of the key things that we need to undertake, one of the key area that we need to take home, or what we can drill in our heads, borrower selection plays a big role in management of delinquency. 2, base loan decision on current capacity to repay and not projections. This I insist very much. I know most of the time we are excited when we look at projections, but projections will never repay the loan. Then the other one, you adopt incentive, positive and negative. You are penalizing both your borrowers and even your credit officers, and of course adopt reliable and accurate data. So I think with that we can be able maybe to control, to put proper controls as far as delinquency is concerned. We can also put some measures in place to help us to deal with already the delinquent accounts that are there. And I always say this, always remember that debts are not bananas. When you keep bananas, they ripen, they become sweet. So I always say take action in good time. Stop delaying. Stop waiting for another month. Take action. If you need a debt collector, go for a debt collector. If you need to take action in terms of seizing the collateral, do that. If you are to reach out to the guarantors, then do that. And that way, you will be putting delinquency under control. I want to believe and I hope these modules has been helpful and will play a bigger role in your organization. I thank you for participating and being part of the team that is learning on how to put delinquency under control in your institution. Thank you. This is Credit and Debt Management again. Our company offers a number of services. We offer debt collection services. We offer training. We offer consultancy. And other things that we do, we also run a school called Tumaini Institute of Management Studies. And through the school, we are also training professionals in the areas of credit management. We also offer diplomas and diploma and certificate in credit management. You can enroll with us and start your career journey in the area of credit management. Once again, thank you for listening. God bless.